Okay, let's jump right in. Think about trust for a second. Would you hand over your hard-earned cash to someone you didn't trust?
Probably not. It's fundamental, isn't it?
Exactly. Yet globally, something like 2.8 billion adults are underbanked. They either don't have a bank account or, very limited access.
And for a lot of them, a big part of that boils down to trust, or rather, a lack of trust in the traditional financial system.
Yeah, and what's really striking is, despite all the tech we have, the basic way money moves still relies heavily on these trusted intermediaries.
It's not just trusting your bank, is it? It's the whole chain of other banks that might be involved.
Totally. Let's picture this. Peter in Zurich. He wants to send, say, $100 to Maria in Los Angeles.
Seems simple enough.
Right. He taps his phone. But behind that click, it's actually a pretty complex journey. Instead of just Peter's bank and Maria's bank talking.
You can have, what, two, three, maybe even five other banks in the middle.
Yeah, exactly. It's like taking this huge detour. And the result, that $100 might take 3 days to show up.
3 days. And the cost.
Could easily be $20 or more in fees. I mean, we can video call someone instantly across the planet.
But sending money feels, yeah, stuck in the slow lane. It's bizarre.
So why? Why the lag? We've cracked instant communication. Why not instant money?
Well, the core issue really is that banks in different countries, they often just don't automatically trust banks they don't know across borders.
Okay.
So to bridge that gap, they rely on these central intermediaries.
Right. This correspondent banking model you touched on. Let's unpack that a bit. What does that actually look like?
Sure. So think of it like smaller banks setting up relationships with a bigger, well-known bank, a correspondent bank.
Okay.
And that bank maintains a central ledger, like a master list of who owes what to whom.
So when Peter's bank sends the money.
It doesn't go straight to Maria's bank. No, it goes to the correspondent bank first.
So the correspondent acts like a middleman.
Exactly. It relays the funds, updates its ledger, but everyone's kind of tethered to this central hub.
And what's the downside?
Yeah.
The catch?
The big one is that single point of failure.
Right.
If that central correspondent bank has a problem, could be technical, could be financial, whatever, it can mess things up for everyone connected to it.
Wow, yeah. That could disrupt a huge number of transactions.
Yeah.
It sounds fragile.
It can be. It introduces a certain level of systemic risk.
You had a great analogy earlier, the flight one. Can you share that? And it really highlights the inefficiency.
Yeah, sure. So Peter wants to fly Zurich to LA. A direct flight is, what, 12 and a half hours?
Roughly, yeah.
But the way his money travels now is like forcing him onto a flight with 2 stops. Maybe Zurich to Frankfurt, then Frankfurt to New York, then New York to LA.
Taking 3 days instead of half a day?
Precisely. Same destination, just a much longer, more complex, and probably more expensive journey. Why should money travel like that?
Which is the perfect segue. How can technology give us that direct route? And this is where blockchain comes in, right?
Exactly. This technology, it's been running since 2009, apparently without a single failure, according to some sources. That's pretty remarkable.
So how does it offer this more direct path?
The fundamental change is that blockchain enables a direct peer-to-peer connection.
Peer-to-peer. Okay.
So in Peter's case, a blockchain system could let his funds move directly to Maria or her bank without needing all those intermediaries.
And crucially,
because it's decentralized, if one participant, one computer on the network fails, it doesn't take the whole system down.
Decentralized. That really is the key difference, isn't it?
All right.
So what's the experience like for Peter then, using this?
For the user, like Peter, it could actually be really simple. He'd use a wallet address.
Okay, like a digital account number.
Sort of, yeah. It's a unique string of letters and numbers. He puts in Maria's address, the amount, hit send. From his end, it seems like it just goes directly.
And the complexity is handled behind the scenes.
Right. The tech does the heavy lifting, but the user interface can be straightforward.
And that decentralized nature, that resilience, contrasts sharply with the single point of failure we talked about earlier.
Absolutely. Centralized system fails, the whole network can be impacted. Decentralized system, like blockchain, one node goes down. The others keep validating, keep processing. It's much more robust.
You explained how it works using a train analogy before. Could you walk us through that again? I found that helpful.
Sure. So think of each transaction, Peter sending his $100 as a passenger waiting at the station.
Okay.
They need to get on a train. In blockchain, the train car is called a block.
Got it. Glock equals train car.
Yep. And there are these mining companies. They're like the conductors deciding which passengers, which transactions get onto the next car, the next block.
Based on what? Fees?
Often, yeah. Fees, transaction size, things like that. They bundle these transactions into the block.
So net.
Then they verify everything, do some complex calculations, and broadcast that block to the network. Once enough other participants agree it's valid, that block gets officially added to the chain. Our train keeps getting longer.
And on Bitcoin, you said this happens
Roughly every 10 minutes for Bitcoin. And when that block is added, it's like the final settlement. Those transactions are done. Confirmed.
And the key thing you stressed was that the money or the value actually moves. It's not just an IOU.
Precisely. It's more like handing over physical gold. Once it's in a verified block on the chain, that value has genuinely transferred from one address to another. It's recorded permanently.
Okay, so how does that block, that train car, get verified? How do we know the transactions inside are legit?
This is where the decentralized power really comes in. When a mining company proposes a new block,
Yeah.
they broadcast it out to the whole network, and then lots of other participants think of them as independent ticket inspectors on our train.
Okay, I like that.
They all independently check the transactions in that block. Does the sender actually have the funds? Are the fees correct? Is everything formatted properly?
So instead of one central authority, like a bank, checking.
You have potentially thousands of independent validators all checking the work. It's verification by consensus.
It's a fundamental difference.
Huge difference. And once they reach consensus, that block gets cryptographically chained to the last one. That's why it's a blockchain. The train just keeps growing.
And every transaction is, in theory, publicly visible and permanent.
On public blockchains, yes. Which leads right into another big advantage. Transparency.
Right. You contrasted it with, like, a bank balance screenshot.
Exactly. Someone shows you a screenshot. You can't really verify it. But with many blockchains, if you have someone's public wallet address, you can actually look it up on a block explorer and see the balance, see the transaction history.
That builds a different kind of trust, doesn't it? Trust in the tech itself.
Trust in the code, in the mathematics, and in the decentralized network, rather than just trusting an institution's word for it.
And the potential impact on global finance is massive. You mentioned 247 transactions.
Yeah, imagine sending money anytime, anywhere. South America to Russia, Australia to Switzerland. Doesn't matter if it's midnight or a public holiday. The network's always on.
That constant availability plus the transparency, it could make illicit activities harder.
Potentially, yes. While anonymity is a factor, the traceability on the public ledger can actually make it harder to hide illicit funds compared to, say, cash. Plus, you remove some of the opacity of the intermediary system.
And you also mentioned users having a choice in how they interact.
Right. You could manage your own funds directly using your own wallet, Provert, be your own bank, essentially. Or you could still use a traditional bank or financial service, but they might use blockchain technology on the back end. You, the customer, might not even notice the tech, but you'd benefit from the speed, maybe lower costs, the 24/7 aspect.
So it offers more economic freedom, more control.
That's the idea. More options, potentially more power in the hands of the individual.
Okay, let's circle back to the start. Those billions of underbanked people. How can blockchain specifically help with financial inclusion?
Right. Financial inclusion, basically, getting affordable, usable financial services to everyone. We know the numbers are huge, billions unbanked or underbanked. They face higher costs, take longer.
And things like the World Bank's UFA initiative highlighted how critical this is.
Absolutely. And for this population, what's really crucial...
Money transfers, I guess. Sending money home, paying for things.
Exactly. Domestic and cross-border transfers are vital, but the current options, often really expensive, slow. People just don't use them much if they can avoid it. Think about remittance costs in places like sub-Saharan Africa, sometimes close to 10%.
Wow, 10% is huge. So how does blockchain tackle these specific barriers?
Well, it can help in a few key ways. Opening an account, actually using the account, and lowering the costs.
Okay, start with account opening. What's the challenge there now?
For many unbanked people, just getting to a bank branch is hard. Then you need specific ID documents they might not have, maybe an initial deposit.
Right, lots of hurdles.
Blockchain simplifies this. You can often set up a digital wallet on a basic mobile phone. And for putting cash in, you could use networks of local agents, like corner shops.
Okay, that definitely lowers the barrier. What about usability? Making the account practical.
Big improvements here. Transfers can be near instantaneous. Fees are often a small percentage, not a big fixed fee, which is better for small amounts, and there are usually no minimum payment sizes.
That sounds much better suited for people managing small daily amounts.
Exactly. It fits the reality of their financial lives much better.
And those critical cross-border payments, the remittances.
This is where blockchain can really shine. By cutting out those intermediary banks, you dramatically lower the processing costs.
And speed things up.
Definitely. It's 247. Plus, you get the security of the cryptography and that transparency we talked about. Compared to traditional bank wires or even some older e-payment systems, it's a big step up.
You also mentioned stablecoins being important here.
Yes, stablecoins are crucial. They're cryptocurrencies designed to hold a stable value, usually pegged to something like the US dollar.
Why is that important?
Because it removes the volatility risk you see with Bitcoin, for example. If you're sending money for daily needs, you need predictability. Stablecoins provide that stable medium of exchange, acting as a bridge currency on the blockchain for faster, cheaper FX without the wild price swings. They're really foundational for a lot of decentralized finance or DeFi applications too.
Okay, let's dig into the payment process itself. You broke it down into first mile, money transfer, last mile.
Yeah.
Contrast the old way versus blockchain.
Sure. So traditional system. First mile is getting money into the system, often requires going to a bank, doing KYC/ML checks.
Know your customer, anti-money laundering. Standard stuff.
Right. Then the money transfer phase, that's the slow, complex bit with intermediaries, FX conversions, potential delays.
The 3-day flight.
Exactly. And the last mile is the recipient getting the funds out, maybe going to another agent, more checks.
Okay, now the blockchain way.
First mile, you still generally need the KYC/ML for regulatory compliance. Can't skip that usually.
That makes sense.
But the money transfer phase, that's where it changes dramatically. The transfer can happen directly on the blockchain using a digital currency, maybe a stablecoin, as the vehicle. It's processed and recorded almost in real time.
Much faster.
Much faster. And the last mile, the recipient still needs to meet requirements to cash out or use the funds, but the core transfer itself was way more efficient.
So summing up the advantages there for cross-border.
Big cost savings. We're talking potentially 1-3% transaction costs versus the current average of like 7.4% for remittances. Huge difference. And less settlement risk because the FX happens nearly instantly.
And for payments within a country.
More versatility. You could potentially transfer value between different systems that don't normally talk to each other. Plus, you see partnerships emerging blockchain companies working with banks, mobile operators.
Like the coins.ph example you gave. Cardless ATM withdrawal.
Exactly.
Yeah.
Using the tech to create new, more accessible ways for people to get their money, bridging the digital and physical worlds.
Okay, but what about the regulators? This always comes up with crypto and blockchain.
Yeah, it's a huge factor. Regulators globally are definitely paying attention. Their main concerns are usually around, preventing money laundering, terrorist financing, the AML/CTF stuff, and protecting consumers.
Are they regulating the tech itself or the applications?
Mostly the applications right now, the exchanges, the specific cryptocurrencies like Bitcoin rather than the underlying blockchain technology itself. The tech is seen more as neutral infrastructure.
And we're seeing different approaches globally, right? You mentioned a few examples.
Totally different. You've got the Philippines, where the central bank is taking this test and learn approach. They require exchanges to register, but they're also trying to tailor KYC rules to help, not hinder, inclusion for the unbanked.
That sounds quite proactive.
It is. Then you have India, where the Reserve Bank has been much more cautious, warning about virtual currencies, not really regulating them yet, leading to some industry self-regulation efforts.
And Kenya.
Kenya's more in the uncertain camp. Lack of clear rules, virtual currencies aren't legal tender there, so it's a real patchwork quilt of regulations worldwide.
It sounds like regulators getting involved early and maybe being a bit flexible could be really helpful.
Our analysis definitely suggests that. If regulators engage early with the companies using this tech and maybe tailor things like KYC for lower-risk unbanked users, it could really help adoption without sacrificing security. A rigid, one-size-fits-all approach might stifle innovation here.
Right, maybe principles-based regulation rather than super specific rules that get outdated quickly.
Exactly, something more adaptable.
So pulling this all together, the big picture on blockchain and financial inclusion.
I think the potential is genuinely significant. Blockchain could be a major catalyst to speed up financial inclusion, potentially empowering billions.
Through lower costs
Lower costs, reduced risk compared to some aspects of the old system, and enabling a ton of innovation.
and tailoring solutions.
Yeah, that's key. The flexibility allows for building solutions that actually address the specific problems people face in different regions,
Hmm.
especially the unbanked. It's not just about imposing a Western banking model everywhere.
So the real insight here, the core takeaway, is that this isn't just a small tweak. Blockchain offers a fundamentally different way to handle finance.
A different paradigm, yeah. It tackles those core issues: trust, cost, speed, access, especially for people left behind by the current system.
It really is about rethinking how money works in a connected world.
Exactly. Reimagining the foundations.
Okay, fascinating stuff. And on that note, let's leave you, the listener, with this thought. As blockchain and DeFi continue to evolve, how might they further change our basic understanding of money itself and what financial freedom really means in the coming years?
Yeah, and maybe check out some of those real-world examples we mentioned: coins.ph, BitPisa, Unacoin. See how this is actually playing out on the ground.
Definitely worth exploring. Thanks for taking this deep dive with us today.